Good morning and happy Friday from Hong Kong. It's 9 a.m. here in the city, in Beijing and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles. Let's get to your top stories today, shall we? Stocks and treasuries under pressure ahead of Friday's U.S. jobs reports with, fairly solid labor market signals weighing on expectations for Fed rate cuts in 2024. Now, going the opposite of that trade, traders are ramping up bets on further monetary easing in China as a feeble recovery pressures authorities to cut rates and boost liquidity. Plus, Islamic State claims it was behind deadly bombings in Iran that threatened to further inflame regional tensions. Right, here we go. Friday's session is ahead, and we woke up this morning, and hence we're starting off with a status report of what's happening in the bond markets, and we're now 4 days down as of last night, so we could get a day 5 today across this route across fixed income where, the 10-year yield in the U.S. Now has a 4 handle to it, generally speaking, as you can see on your screens. Yields are continuing to push higher in the Asia Pacific. As you can see, Australia's up 5, and we're up a little bit from 2020-ish lows in the Chinese 10-year yield. Also had a massive drop across Europe yesterday. Just keep in mind we have inflation numbers coming through, prelim numbers for December out of the Eurozone today. We're getting some declines right now, some weakness still coming through in Bund futures. That takes us straightly into currency markets where the dollar is on track, as you can see bottom of your screens, for the best week in a couple of months, hence dollar China. We'll talk more about the significance of this upcoming fix out of the PBOC today. Plus, we also talked about, liquidity injections. They've actually been draining liquidity from the system this week here. More on that in a moment. Dollar yen seeing a bit more weakness coming through as well on the back of dollar weakness, plus some repricing on expectations around the BOJ, and that's now being pushed. Any sort of potential change is being pushed to the meeting after January. Commodity markets, nothing much to tell you about here as far as this is concerned. Iron ore is taking a bit of a pullback right now. Copper, though, at least is steadying. I think we're down about 5 straight days into today, so watch that very, very closely today. And of course, a setup as we approach the equity market open in China and Hong Kong. Here we go. A50 futures in Singapore. You have U.S. futures as well. Asia Pacific better by about 0.1%. NASDAQ, of course, and sort of the tech story and the melt up in yields and the meltdown we're seeing in growth stocks right now. Steady on NASDAQ 100 futures, 0.1% to the downside on A50 futures. Right. Now, I believe we have some inflation numbers coming through out of the Philippines and lower than expectations. 3.9% is the figure there. We were looking for a 4% handle. So next meeting, if I'm just rattling my brain, BSP should be around Feb 15. There we go. Thank you so much. Remembered randomly. Okay. Well, the inflation conversation takes us into the Fed conversation, and this time going into the new year, expectations for a Fed cut in March was closer to a done deal. Now it's actually closer to almost coin flip probabilities. A lot will depend on the upcoming data, including the big one coming out today, of course, which is the jobs report. A preview right now on those numbers. Belle is with us out of Sydney. Belle, just take us through the expectations first and foremost.
Yeah, well, of course, there's been a pretty big range of estimates that are coming through. But if you were to take a look at the median one, it's for 175,000 roles to have been added over the course of last month. That would follow from about 200,000 added the month prior as well for November. So overall, if you take a look at the course of jobs that are being newly created over the course of 2023, that's about 2.7 million. Quite a meaningful deceleration from the year prior, but still, if you were to take a look at that period from 2015 to 2019, actually it tells us that labour market was pretty robust last year, and so that's obviously not a great signal to bond markets that have been really quite aggressively pricing in those Fed rate cuts. Of course, you've also got to consider what's really driving that. Is it being led by the private sector? Is it being led by the public sector? And again, a few different views here, but one of those is from Bank of America, and they're saying mostly this is job creation from the government side, so around 1 in 3 roles perhaps over the course of December. Private sector, the story is just a little bit different here. So you've got some sectors that are looking better than others. There's still that really robust, resilient demand for services. So things like education, health, leisure, hospitality, these are all seeing pretty good gains. If you take that out of the equation, though, it's not quite as strong or robust, that picture.
Well, the expectations are, let's look at Bloomberg Economics, Belle. They're a little bit more cautious. Is that accurate?
Yeah, that's right. If you take a look at what they're expecting, it's for non-farm payrolls to have increased by 140,000, and they're actually saying as well we'll see revisions downward for the 2 months prior. What they're also going to be watching is that unemployment rate, and they're expecting that to tick up to 3.9%. Again, that's just slightly higher than what other economists are seeing, the average projection for 3.8% instead. But still, they're sharing that view from Bank of America that it's really being driven by strong services demand. They're more cautious on areas like manufacturing, finance, other business services as well. The picture overall, though, they're saying that's not great for other pockets of the labour market, and people generally who are unemployed, they're staying out of work for a longer period. More people as well could have lost their jobs, and the question, of course, is exactly what that means for the Fed and that expectation for rate cuts over the course of this year.
Belle, thank you so much. Annabelle there with a preview of the upcoming numbers. NFP, of course, big one coming up. And really, Belle ended that with a very salient point. You know, how does the Fed view this, right? Particularly with that number and expectations getting pared back for March. You have Tom Barkin, I believe, also speaking as well. So a lot on deck today. Let's bring in Garfield Reynolds, our chief rates correspondent for Asia, also MLive contributor. Garfield, weigh in on this reversal we're seeing this week, yields melting up, stronger dollar, and this bond route that's not a spread beyond U.S. Treasuries, of course.
Yeah, well, Dave, I mean, a big part of what's going on is that the end of 2023 euphoria was so intense that, you know, unless you had some sort of, you know, serious bad economic news to back up the idea that the Fed could start cutting rates as early as March, you were, you know, cruising for a bruising, so to speak. Sure enough, we've had some bruising, and you know, there had been some signs within the jobs market data pulse, even at the end of last year, that things weren't necessarily deteriorating rapidly enough to back that, you know, I mean, 6 rate cuts priced in for 2024. That's pretty close to pricing in a recession. And the labour market was a long way from backing that up, even as it was showing signs of cooling at the end of last year. Now we've had a few partial indicators this week, ones that are often false friends, and they've, you know, very much backed that narrative. So given also we've had a bit of a spurt in corporate issuance, which is usually hedged by selling treasuries, it's completely understandable we've had this sort of a backup in yields. A lot of people think that treasuries under 4% at this stage on the 10-year yield don't make a huge amount of sense. So the bias is going to be to the upside for yields unless we get you know, a sustained set of downside data surprises.
Yeah, or to your point there, maybe a shocker of a job sprint later today. So Garfield, I guess to your point there, we're trying to figure out this route continue, and you started out by saying 6 cuts were priced. Let's say they start in March. It's almost every meeting this year. Well, 6 cuts are still priced, even after this route as well. Can this route continue on that note?
Well, I mean, for the route to, you know, really sustain from here, well, okay, 2 things. One, as I said, 4.1 to 4.2 can easily move to those sort of levels, you know, even without, you know, serious upside surprises. All it needs is the avoidance of downside surprises, and also the avoidance of any Fed speaker, say, coming out and saying, yeah, actually, we think it's possible we could, you know, we could cut a bit earlier than we might have thought. So absent that, the trend is up to about that 4.1 level and a bit higher. How fast we get there depends to some extent on the data. Whether we can go above that that would depend on some serious, like you would need to get an upside surprise for CPI, some hawkish Fed commentary to seriously push back. Otherwise, once you get above 4%, you're likely to start to see serious money coming in, going, well, we weren't so sure at 3.8, at 4% or above, that's worth holding on to.
We'll see. Garfield, you sound like 2023. Let's see what happens today. Garfield Reynolds there, our chief rates correspondent for Asia and our MLive contributor there. Right, in just under 5 minutes from now, we're getting the fix of the day, your midpoint out of the PBOC. Reason that's important, I'll make this very quick, is the last few days has actually seen the yellow square you see on your screens, a widening of that spread. In other words, some signs of stability, if you will, or at least a preference for a stable rate given the dollar strength. So we'll see what that spread looks like in a couple of minutes. Right, just ahead, we're speaking with Moody's, and they're basically coming on to explain why their negative outlook in China continues this year, with risk skewed in their view to the downside because of many, many reasons. Lena Choi joins us. But before that, JP Morgan Asset Management tells us why they're upgraded equities to overweight and why they're actually seeing pockets of opportunity. Counting down to the open of trade, final session of the week, Shanghai, Shenzhen, and here in Hong Kong. This is Bloomberg Markets China Open. Good morning. All right, so we're just over 15 minutes away from the Friday session where, by the way, the CSI 300 is within 1.5% of that low we hit back on December 20. More on that in a moment. As you can see, futures are pointing to a relatively uninspired open this Friday. Let's bring in Sylvia Sheng, global multi-asset strategist at JP Morgan Asset Management. She's with us right now. Happy New Year.
Happy New Year.
The New Year saw almost right on the dot as we turned the page on that calendar, a reversal of that manic move that we saw in December. Well, two things there. Do you think markets overshot the target in December? And do you see this cross-asset move correction as we continue?
So I think if you look at the technical indicators for equity markets, some of them are looking a bit more stretched. So some near-term consolidation probably expected just given the speed of the move up. But we do think this year, when we look at equities, we do think it's supported both by a moderating growth, but not really a recession. We think very limited risk of that. But also the fact central banks are shifting to a rate cutting cycle. We think that easing of financial conditions should be supportive of our asset market.
Okay, so let's pick up on equities. When you say equities, that's a big word. Where in the equity complex do you want to be?
So we have overweight stance on global equities, but within equities, we have a preference for U.S. large cap as well as Japan at the moment.
Okay, so Japan. So, and you mentioned rate cuts of duration. Do I want that right now? Do I buy this dip in treasuries, for example?
Yeah, actually, we think that at current levels, still pretty attractive if you think that we're actually getting into the rate cutting cycle. Clearly that before the rate cuts actually happen, we think that there is probably a range trade right now, but it could move lower once we see the rate cuts coming through.
Right, and what is your working assumption on the number of rate cuts we see? Because it's now 6 over 12 months. That seems aggressive or no?
Yeah, it seems a bit aggressive to us. Our base case is about 4 cuts this year, probably start somewhere in the middle of the year. We think the recent commentary from the Fed, especially the minutes this week, probably push back against a very early cut this year.
Okay, and credit? Where do you want to be? High yield, U.S., Asia, for example. Asia, you have some supply issues here, of course, but in the U.S. things look expensive.
Yeah,
right?
So if we look at across the credit complex, we still have a preference for U.S. credit, and especially in high yield. We do think in the environment we do not see recession, that carry trade still makes sense.
Okay, biggest risk to your view? What might change your mind?
If we do have a recession, I guess that will be a big change in terms of how we're looking at the asset market. But that overweight to duration still provides you that hedge.
Okay, we need to ask you about China. This market's been cheap for a long time, so that's not new news. Has Have you gotten more queries on this market? I mean, is cheap enough to attract buyers back in?
I think we're probably at that point, and especially when we saw more policy easing coming through kind of late October, November time, we did get more questions about the policy trajectory. We think that's key to the growth momentum this year. And given the light positioning as well as low valuations, we think there is room for it to rally from here.
Okay. Anything else we're missing in terms of, so you mentioned risks, so recession. Geopolitics has come back as well. Earnings, is that a big risk? Anything else that we're sleeping on as we look at 2024?
I guess the other risk from a macro perspective is just whether the disinflation would continue. And if we still have a relatively okay growth environment, is that enough to really see inflation going back to target?
Okay, what do you think about cash? I know that's out of left field, but a lot of people have told us going into this year, the cash strategies that worked last year probably don't do that this year, but rates are still relatively high on the short end, at least over short term.
Yeah, they're high, but they're gonna go down, right? So we are underweight. We are underweight cash at the moment. We think all the other asset classes look more attractive.
Okay, Sylvia, nice to see you. Fantastic. Sylvia Shang there, of course, out of JP Morgan Asset Management, global multi-asset strategist. So just to recap some of their views there, overweight equity markets. Within equity markets, it's U.S. markets, large caps there. So this 5-day drop on the NASDAQ, is it 5 days or 4 days? Doesn't really matter. Might be worth paying attention to. That's number one. And of course, within the Asia-Pacific equity complex, it's Japan. Duration, let's let maybe markets settle for now, given the manic move that we saw, of course, back in December. But duration is where you also want to be. 6 cuts over 18 months, not 12, as currently priced in this market. Okay, right, just to recap some of their views there. Now, over to Japan, we have some breaking news coming through. This concerns what happened, of course, at the Haneda Airport earlier in the week. So Japan Airlines has now canceled 102 flights. That's for today because of the restrictions that are in place at the airport there. So again, to recap that, Japan Airlines, and this is only the single airline so far, has canceled 102 flights this Friday because of the restrictions on the current runway at the Haneda Airport. Now, also coming through as we were having a conversation with JP Morgan Asset Management, the fix of the day was out and the spread is just under 600 pips. Your fix for the day, so slightly wider than expectations. 710.29. The expectations were 715.89. Okay, we'll get you a preview of the trading day ahead, so stay with us. This is Bloomberg. Good morning. Okay, big election year, 2024. The one that's nearest to us right now is, of course, Taiwan, and investors are certainly watching the build-up to elections there for really clues on at least the path forward for cross-strait relations and certainly the impact on global supply chains, particularly in semiconductors, of course. Let's bring in Sang-Mi Cha, our Asia stocks reporter. He's with us here on set to talk us through, of course, the trader's guide to the Taiwan elections and how might the outcome of the vote, of course, impact the general mood in the stock market.
Well, the stakes are pretty high for Taiwan and its benchmark, which has been trading at an all-time high. It's already outperformed most of its peers in 2023 amid the artificial intelligence boom and turnaround in the semi-cycle. So we know that we're hearing from the money managers that the market has already priced in a lot of the DPP win, but a narrower lead or a surprise win by the opposition party, which is more China-friendly, would be actually a boon for the Taiwanese market and good for the stocks too, because that would alleviate some of that risk sentiment against China.
Yeah, talk a little bit more about that. So DPP, that's currently more priced than KMT, of course. What would a win from either side mean for the chip sector, separately, of course?
For the chip sector, it's a huge sector to watch, especially given Taiwan produces around 90% of the world's most advanced chips in the world, really. So, and TSMC, it has 27% weighting on the TAIEX benchmark. And so the PP win, some say that it's going to be a status quo. It's going to mean that the Taiwan is going to enjoy its current status of independent location where they would go and fabricate chips and assemble the artificial intelligence servers. But a KMT win perhaps could mean that some of the companies could drive away or shy away from the island and perhaps diversify their supply chain. And so there is that large element there. So a closer cross-strait ties with China could be good for the market, but it could put the chip industry under the U.S. scrutiny.
Okay, so that's, everyone talks about chips. What other sector should we be having trouble speaking, it's Friday, should we be paying attention to as we look at these elections? So whether sectors or specific stocks? Yeah.
Well, the energy sector is definitely an industry that the investors are looking at because that's where the ruling party and the opposition party policies differ. And the ruling party has been honing for something more of a faster shift to renewables. Basically, they want to phase out the nuclear plant by 2025 and have an energy mix coming from the renewables, 15% of it by 2025. So that would mean good news for the wind power companies that have been benefiting from the ruling party policy. But a KMT win would be actually perhaps of a growth or like a slower growth driver for the wind companies because they don't want to phase out the nuclear plants immediately and they want to take a rather gradual shift towards the renewables. We have the tourism sector where we have been seeing some of the cross-strait restrictions, especially when it comes to group tours. The presidential candidate from the opposition, KMT, has been saying that he will immediately open the door for the mainland tourists. So that would mean it's good news for the hospitality and some of the airline stocks that we have in Taiwan. And finally, we have defense names. All three of the top presidential candidates have said that they will be bolstering the military capabilities by increasing defense spending. So that would mean that it's good for the sector itself, but then a DPP win could mean that some of the shipbuilders might do well because they have been pushing for domestically produced submarines.
Okay. Fantastic. Comprehensive there from Sang-Mi Cho, of course, our Asia Stocks reporter. More on that, by the way, Trader's Guide to the upcoming elections, and also more on these elections coming up on Taiwan Decides, a special report. Details on my right, featuring our exclusive interviews with all three presidential candidates. Catch it on Bloomberg TV every Thursday in Asia and Wednesday in the U.S. Also available, of course, on the internet. That's on YouTube. Okay, let's look ahead to the open. And this, we're set to drop across these equity markets, cash markets in Hong Kong and here in China. Might have to do with the fact that the PBOC has been draining quite a substantial amount of money, in fact, Tuesday to Thursday. And this latest amount that they've taken out today via repos, reverse repos, now takes the weekly aggregate amount to the biggest withdrawal or cash drainage on record. 411 today, nearly 2.5 trillion, I believe, over the last 4 days or so. Right, a chart to watch for you today is the specific level, December 20 close on the CSI 300, 3283. Analyst actions, Morgan Stanley's been very busy. A brief look at that, and of course the agenda today. We're looking at maybe some data coming through, FX reserves out of Hong Kong, plus a couple of debuts here in Hong Kong. More on that in a moment. This is Bloomberg. Welcome back and happy Friday. We're looking at declines ahead of the open here. So one level you want to watch is 32.83 on the CSI 300. We've topped the 200-day moving average in dollar China. This rally that's taking place, of course, across CGBs. We're taking yields back to 2020 levels. And a couple of debuts. And here in Hong Kong, it's RoboSense. And the IPO price at 43. And I understand it is opening up at about 43. So uneventful start. It is, of course, just day one at school. Let's look at the graduation there, of course. 10 seconds away, give or take, from the opening bell. Global stocks, and here's the backdrop, right? So if you think markets here are declining in a vacuum, global stocks are actually on track for the first weekly decline in about 10 weeks or so. So it hasn't been a good start to risk assets. And here we go. As far as the open is concerned, and we're looking at declines, Hang Seng is down about 0.8% in the early going. Some of the big tech plays are down about 1.1%. 8 shares index, 0.9% there. Let's flip the boards, please, if we can, and just have a look at other areas of this market, of course, that we're tracking very, very closely. There we go. CSI 300 Financials Index. So with the exception of, I think, two, which is a fairly obvious color distinction on your screens right now, most sectors are pushing lower as well. At 33.30, so that now puts us within about 1.5% of that low that we hit. Bottom of your screen's RoboSense opening up here in Hong Kong. 43 is your IPO price. 42.90. Two more things before I move things along. One is on the renminbi fix of the day, which came in at a slightly wider spread to estimates than this week, and this week has actually been wider than the previous 3 weeks. So we've actually seen maybe some level of anchoring, if you will. It's also been a week the dollar has been strengthening across the world. The other thing I want to mention is the PBOC, also on that note, has been taking the ATM to open market operations and taking out some money here. In total, net via reverse repos this week, 2.423 trillion. That's a record amount taken out of the system this week. Okay, well, it's just the first week. We'll see what happens, of course, through the rest of this year. And yeah, we have the jobs report later today, too. I'll talk about that later. Okay, let's talk more on China. Risk profile, corporates, non-financial corporates. Joining us here on set, Moody's Investor Service, Lena Choi, Senior Vice President there. Good morning.
Good morning, David.
Oh, thank you. You beat me to it. You're not too optimistic. I'm looking at your report. I was happy coming into today, and it's making me slightly more depressed. Credit conditions will worsen in 2024. Lay out the thesis.
Thank you, David. Actually, yes, we do project that credit conditions for non-financial corporates in China will worsen this year for two reasons, and they are connected. First, we all know growth is going to slow further. Moody's forecast is GDP growth in China this year is going to be around 4%, which is, a fall from 5% last year. And even longer term, because of some structural factors such as weakening demographics, we are, looking at a longer term, even further slowing going forward. Also, the second reason, of course, is prolonged property sector downturn. And that is going to cast adverse spillover impact across many sectors. Direct, indirect impact across a number of sectors that would continue to dampen consumer confidence, business confidence in investing. And that's why we see definitely a lot more challenges than upside risks for the coming year.
Okay, so you mentioned sectors, and properties, of course, property itself, but it affects many other sectors. So for investors, as you know, it's all about the change. What sectors do you think might lead this deterioration in the credit profile? And what does the opposite do? Let's look at the bright spots too.
Of course. I'll start with the property sector negative impact first, which is the key thesis of our negative conditions outlook. The issue is the direct impact of the property prolonged downturn of that sector. First, of course, is going to reduce activity across the closest to property value chain sectors, building materials, steel, consumer durables, just to name a few. Yeah. The second type of direct impact is actually felt on the funding access, particularly for the high-yield privately owned enterprises. Now, just to quote you some statistics, this year and next, 24 and 25, for the rated non-financial corporates, we are looking at around 33 to 35 billion of debt coming due. Around half of that will be for high-yield rated corporates. And with the rates offshore, the U.S. borrowing rates being higher for longer, a lot of these high-yield companies are going to face refinancing risk or difficulties because they are one option short. Yeah. So, and in the last 12 to 18 months, we have seen very, very restricted access to funding access. So that's part of our concern as well. Now, switching a little bit to the indirect impact. Sectors that are less immediately sensitive to property sector downturn. But longer term, if the situation continues and having a negative feedback loop, to the broader macroeconomic environment, sectors such as autos, large ticket items, purchases, discretionary retail, trading activities are all going to be negatively impacted.
And the bright spots?
The brighter spots, of course, would be sectors that's more in line with the Chinese government's attempt to rebalance economic drivers for the longer term. They have handpicked a couple of strategic sectors, for example, high-tech manufacturing, for example, renewable energy, or new energy vehicles, for that matter.
Since you brought it up, that's interesting, because does that then affect some of the carbon-heavy industries, for example?
Yes.
So this push towards renewables, what happens to the old sector as well? How are you looking at that shift? Because it's taking place, but very, very slowly.
Yeah. Very slowly is actually the key word. You're right, David. I think China has laid out very clearly its carbon targets.
Okay.
2030 peak, 2060 carbon neutral. So the old sectors, the more traditional sectors, oil and gas, chemicals, they are facing in a heavy investment phase going forward, and their credits will be gradually impacted on that front.
What about let's look at the offset from support measures, right? So authorities have laid out, it's a very long list now, so everything from let's keep interest rates low to guidance to the banks to provide financing to funding costs and funding channels. To your point, has it helped materially? Do you see an improvement incrementally since they came out with all these support measures to increase the funding options for many of these corporates?
In some cases, it did help. The property sector, for example, I think some measures has been very targeted at helping the liquidity of developers, private developers in particular, in order to restore market confidence. And as you correctly pointed out, keeping interest low for the SOEs, which have much better funding access for domestic banks and domestic bond markets, those did benefit. But so far, we have not yet seen a sustained or strong enough supportive measures that would lead to a sustained stabilization of the property or the more certain funding access for the broader private-owned enterprises.
And is it accurate as a guiding star for credit investors to go along the lines of SOEs are generally the better bet than POEs?
In general, I think credit conditions, especially on the funding access front, yes.
Okay. LGFVs. That's another interesting part, because yesterday on the show here we were talking about this record amount that's maturing this year. I suspect that the headline is scarier than the actual reality and the nuance there. How are you guys looking at LGFVs this year and the risk profile there? Is there credit differentiation to talk about there? Because they have introduced a lot of measures, including the swap program, of course, to address that.
Indeed, there has been some credit differentiation on the LGFV front as well. We all know that LGFV debt has been rising in the last few years, and also, this is a sector that will have some credit differentiation from the adverse impact of property as well.
Okay.
For regions and local governments that are heavily reliant on land sales receipt, they will be more heavily impacted because we all know they are in for a long-lasting and structural decline in land sales receipts. The LGFVs that they owned, if they are really very reliant on property sales, land sales receipts, that will reduce the local government's capacity to support the LGFV, which are usually involved in public mandates that may have not sufficient economic returns on itself.
Okay, final question. What changes your mind?
Yeah. So far, it does sound like it's all negative, doesn't it? But we are looking for a few, we will be monitoring for a few key things. First and foremost, I think, would be the sustained stabilization of the property market situation. And therefore, with it, hopefully, the more certain and, again, sustained funding access for the companies in that sector. And, of course, we will also look for stronger, for the policy effectiveness to be higher, and therefore stimulate stimulating a stronger economic growth that would help a lot of sectors. Last but not least, we'll also like to see reduced regulatory uncertainties for some sectors that we have come through in the last 12 to 18 months. And also if the external environment, including geopolitical tensions, to subside a bit.
Right. Well, since you brought it up, can I just ask you a final follow-up on that? Regulatory uncertainty. We've had a reversal on the tech, on this gaming thing recently before Christmas. So, bigger question, I guess, just very quickly. Do investors still need to grapple with increased regulatory risk and not so much uncertainty?
I think we are still on the uncertainty side. We actually don't see the new draft regulations for online gaming as anything completely new. If you look through the 8 chapters, it's actually a lot of that is not new. So, and it has not caused significant change to the credit quality of rated companies.
Lovely. Lena, nice to see you.
Thank you.
Lena Choi there, Senior Vice President at Moody's Investor Service. Right, coming up here and shows the latest on rising tensions in the Middle East as fears grow of a widening conflict in Gaza. This is Bloomberg. Oil markets looking like this, at least the most active contracts on each of the sort of major classifications, if you will. Brent, West Texas, Shanghai crude, and the equity market iteration of energy right now slightly lower. We're still slightly higher. In fact, I think we are poised for a weekly gain there as far as global oil prices are concerned. Might be down to, of course, what's happening in the Middle East here, where the latest is Islamic State is, in fact, claiming responsibility for the deadly bombing in Iran on Wednesday, and attacks that threaten, of course, to further inflame tensions in that part of the world. Bruce Einhorn is with us here to take us through the latest on what we know on these attacks, including, of course, Islamic State raising their hand here.
So, David, Iran had said that the attacks were punishment for its support of Hamas in the war with Israel. The U.S. has always said that that was ridiculous, that this had all the hallmarks of an attack from Islamic State. Islamic State did indeed claim credit for it. Islamic State, Sunni Muslim extremists, ideologically opposed to the regime in Iran, which is Shia. So there's a long history there.
Yeah. Antony Blinken, he's set to return to the region again. Is it the third or fourth? I'm losing count.
Yeah, it's his 4th trip since the start of the war.
Okay.
He's going to be a busy man. He's going to, I've got all these written down, Greece, Turkey, Jordan, Qatar, UAE, Saudi Arabia, Egypt, Israel, and the West Bank. So a lot of places. Of course, a lot of attention will be on his discussions with the Israelis. According to a State Department spokesman, the Secretary of State will be talking with the Israeli government about the next phase of the war. Israel has said that it is reducing its troops in Gaza. The Secretary of State will also be talking about increasing humanitarian assistance to Gaza and what comes next beyond the fighting.
Right. Now, talk about the Red Sea, too. That's also part, because that's also seen arguably an escalation as well over this week, starting, of course, with the weekend with Maersk.
That's right. Yeah. So since mid-November, there have been more than 24 attacks in the Red Sea by Houthis who are backed by the Iranian government. A U.S.-led coalition has been active in the Red Sea for about a few weeks now, trying to protect traffic through the area. According to the Vice Admiral from the U.S. Navy, who briefed reporters on this yesterday, so far it has not worked. The Vice Admiral himself said that so far the attacks are unabated. Most recent attack was there was an unmanned ship, essentially like a seaborne drone, that exploded a few miles away from some merchant ships in the Red Sea. One thing to really keep an eye on here is that, according to a UK official who spoke with Bloomberg News on the basis of anonymity, said that the Biden administration is considering the possibility of additional military action in the region, in particular focused on the Houthis. This UK official said this would also be something that the UK would support.
Thank you for the latest there, Bruce Einhorn. They're getting us up to speed there on all things in the Middle East, all related stories as well. We ended that conversation on the latest in the Red Sea. Now, in case you missed it, so shipping container rates have actually surged on the back of what's taking place there as ships, well, number one, reroute around the Horn of Africa. And it's certainly, in terms of just a market iteration of this, Goldman Sachs upgraded, in fact, Maersk and other of its peers there. I think Maersk upgraded the stock to neutral from sell. And the bank says that these detours will actually boost freight costs and improve the company's free cash flow. And Maersk, as an example, their extended gain second session, I think we closed at a multi-month high on that. Okay, now let's stay on transport, but on the other side of this break, we're talking BYD and how it beat Tesla at its own game to become the global king of EVs. This is Bloomberg. Right, welcome back to shows broad declines across equity markets. BYD, as you can see, moving against the grain here. It's been up for, I think, at least 2 weeks in a row right now. 213 a pop. We'll talk more about how the market's positioning as the stock continues to rise. We're getting a lot of doubters there in terms of the short side. Now, on BYD and sort of big picture here, so Elon Musk's and Tesla was overtaken by China's BYD last quarter as the world's top-selling electric car maker. Our transport reporter Daniel Lee has been looking into the factors that actually made BYD the king of EVs. Have a look.
It likes to describe itself as
the biggest car brand you've never heard of.
Now, China's BYD has overtaken Tesla as the world's largest seller of electric vehicles. Its success is a fruit of long-term strategic thinking on the part of BYD itself and the Chinese government.
We've arguably never seen anything like this in terms of, the amount of support that China has extended to automakers, specifically pertaining to EVs.
Most of BYD's cars are simply a lot cheaper than Tesla's.
They have very cheap models starting from $10,000 US. The most important factor is that BYD is the only automaker that produces all of its batteries in-house.
Making its own batteries and other components helps it reduce a lot of costs. All of this is setting China up to be the dominant global player in the transportation of the future. Electric vehicles, a business that could be worth $8.8 trillion by the end of the decade.
Let me fix it. All right, you can check out more of that Bloomberg Originals documentary right now, in fact, online and on YouTube. And for subscribers, you can also check that out on the Bloomberg terminal. And if you have internet, that's Bloomberg.com. Okay, more on BYD right now. So, we mentioned, of course, the stock is on the way up. And it's also become a target of short sellers. In fact, some of the bearish bets are at around 3-month highs right now. Let's bring in Charlotte Yang, who had the story for us, of course, this week. So what is going on here, Charlotte?
Yeah, so if you're actually looking at the positionings, whether it's options data or short interest level, you can see that actually investors see that the stock might fall further, even that it has already took a bit in the past few months. And I think the positioning is really a snapshot of market's broader concerns for the whole sector, because there are a few causes here. First is growth will decelerate. This year we have been seeing really strong sales in EV for China, but next year, given the high base effect and also the challenging macro environment, analysts expect the sales to slow, and also that for BYD as well. And secondly, competition is intensifying. You have over 150 models expected to come into the market. Over 80% of them are going to be EVs, and also with entrants like Huawei, its capabilities of intelligent driving and autonomous driving, those are not the strengths of BYD. Its cars are known to be safe and also cheap, but with the competitions posted by likes of Huawei and Xiaomi, I think investors have a lot of concerns about the sales momentum into this year, and also how promotions will, even listing prices are falling, but how increased promotions to boost sales might weigh on the margins.
So, I mean, does it continue? I mean, does it make sense still at this point to increase your short position, short interest, to your point, a multi-month high already, if not above that?
I think given the industry, outlook, investors we've been speaking to, they're quite bearish on the stock. The company is a great company, great fundamentals, strong cost management, but it's really about industry outlook. And it's not about competition with Tesla. It's more about competition posed by, Huawei, the likes of Huawei.
All right. Charlotte, as good point out of Charlotte there. Good company, maybe terrible stock. That's a common feature, of course, of these markets. Charlotte Yang there, our Asia Stocks reporter. Right, stay tuned, by the way, for our conversation with a BYD-backed company. That's a trading debut. RoboSense is debuting in Hong Kong today. It's a maker of sensors used in self-driving cars. That's making its day one trading day, at least here in Hong Kong. As you can see, bottom of your screens, we're trading at 42, IPO price 43, a pop. Okay, other names that we're tracking here in the region and in this Chinese market. So we're looking at tourism stocks. And the reason we're doing that is we're getting some information here that there was actually quite a substantial amount of travel taking place right now. And some of these names, as you can see, are limit up 9-10% onshore. A broader look at these markets. And keep in mind, global equities have been on the way down this week. So I think we are on track for the first weekly drop in about 10 weeks or so. CSI 300, though, reversing earlier weakness. We're now trading at 33.50. Hang Seng Index fairly reflective of the broader read across global equities right now. S&P futures are flat. Most sectors are still seeing some selling pressure, but not a lot. So we'll talk more about what you do. Do you buy this dip? To help us answer that question in the next hour, Bloomberg Markets, Pepperstone will be joining us to talk through their calls, and also an exclusive interview with a hotel. Poh Man Loh joins us to talk about the plans for the business. This is Bloomberg.